Welcome to Trading Pro. Today we're continuing with complex pullbacks. As usual, when we get a chart, we first look at the bigger time frame to see its market state. Some friends ask me if there's a systematic decision-making process in trading. Actually, it's quite simple. The entry for trading can be divided into these 3 steps. First, you look at the larger time frame market state. Is it trending or ranging? Find the direction you want to trade. After finding your direction, go to a smaller time frame to find your pattern structure. For example, you want to trade a wedge, a channel, or other patterns. After finding the pattern structure, finally look for the entry candlestick pattern. For example, you want to use a single candlestick reversal to enter, or a double candlestick reversal, or a second breakout to enter. It can be divided into these 3 steps to make an entry for a trade. Order management after entry is the subsequent part. Looking at this chart after enlarging it, we find that it is actually in an upward channel. This upward channel has been running for a long time. We've talked about how all upward channels are bear flags because the probability of a downward break from an upward channel is greater than an upward break. There's a false upward break here. Experienced traders would short here, aiming for the price to test this upward trend line. Given the current market state, we tend to look for a structure or pattern to participate in short trades. Looking at the micro details, there's a sharp drop in channel pattern here. I often talk about this pattern. It tends to test the starting point of the channel. In this case, it would tend to test this level. At the same time, the target of this sharp drop in channel pattern is right on this ascending trend line. In addition, there's another logic. The target of this channel run is also measurable. See this level? The price just overshot a bit. This is a basis for major short traders to close their positions. Coupled with the previous level of horizontal support, the price also made a thrust at it. Under such multiple long logics verification, this is actually a very good position to enter a long trade. We see that the price broke above this downward channel. All downward channels are bull flags because they tend to break upward. I won't repeat this again. After it broke this flag, it made a pullback. Up to this point, the logic of going long is still very good, receiving a preliminary validation from the market. If we remove the subsequent candlesticks, it becomes very clear. We can see that for the breakout of this bull flag, this candlestick is a very good second entry candlestick. Up to this point, if we look at it from the logic of going long, it is actually very good. But we know that the price didn't rise subsequently, but instead accelerated its drop. The perfect entry logic with multiple validations was quickly denied by the market. This is very common in trading. When this happens, stop loss promptly, reanalyze the current market situation, and make the correct judgment. Never compete with the market. Many traders, after their perfect judgment is denied by the market, fight against the market and directly blow up their account. We must avoid this situation. Admit it when you should admit it. I often say that even though this trade was denied by the market, it does not mean that we were wrong. To be precise, it does not mean that our trading logic, our trading system, was wrong. Most traders have 2 cognitive biases: outcome bias and recency bias. Outcome bias refers to traders judging the quality of a decision solely based on its outcome, without considering the quality of the decision itself. Recency bias refers to traders placing more emphasis on recent data or experiences, overlooking earlier experiences or data. What could these 2 cognitive biases lead to? Many novice traders or investors, upon seeing an analyst accurately predicting the market 5 or 6 times in a row, may believe that this analyst is very competent and reliable, and decide to follow a next move. They do not consider whether the logic behind these judgments is correct, nor do they pay attention to the analyst's past data. They make judgments based on recent results and feelings. These types of participants who dislike thinking for themselves often leave the investment market with significant losses or even total losses. Here's something to understand. Analysis and calling trades is easy. You take a trend-following system, such as the most common moving average system. Wait for the moving averages of various periods to form a trend arrangement, and then you call trades in the direction of the trend. You're always right. It's really easy to call 5 or 6 consecutive correct trades. So what's the downside to a trend-following system? Firstly, the market is only in a strong movement state for a very limited time. When many trend attempts fail, this trend-following system will continually grind down your capital. Secondly, many people only look at trends but don't understand when a trend ends. At the end of a trend, when the market has already produced a clear pattern that is unfavorable to you, they do not close out and leave or even add to their position. This is likely to cause all the money earned in the entire trend to be lost. But many people do not pay attention to the logic behind these systems. They don't know what system the analyst they're watching uses. All they know is that their recent calls have been correct, so this analyst must be amazing and reliable. This way of judgment is clearly illogical and incorrect. There's another scenario where a trader has just gotten past the beginner stage, mastered technical analysis and various trading theories. They then design their own trading system to operate. It works well at the start, with some wins and losses, but overall there's still considerable profit. But one day, or during a certain period, they suddenly experience consecutive stop losses. At this time, they may start to doubt whether there's a problem with their system. Why have they been losing money recently? Their emotions are affected, and even when a trading opportunity arises within the system next time, they dare not enter, fearing a stop loss. Is this kind of thinking correct? They focus on the recent 7 or 8 trades that hit stop losses and feel that the system is unreliable. But they ignore that this system has been profitable for a long time in the past and brought them substantial returns. This is how recency bias affects a trader's emotions. We should view all the trading results within the system as a whole. Analyzing individual trading results cannot judge the quality of the entire trading system. Having recognized the negative impact of outcome bias and recency bias on traders, novices should practice overcoming these cognitive biases from the start and view trading results in a comprehensive, objective, and logical manner. Returning to the chart, we might wonder why it didn't rise as expected at a certain point, but instead accelerated downwards. Sometimes there is no need to analyze the market down to its roots. Accepting the objective facts and making new analyses and decisions is often sufficient. The true logic behind some market movements may be something we can never fully understand. The failure of the long bullish logic here could be because the main long holders did not buy heavily at this level. Recall our previous analysis of the market's large cycle movement state. It was a long-lasting upward channel. During this upward channel period, the main long holders may only be willing to make a big entrance at a lower level, no longer defending this level, so it fell through. Continuing to analyze the later market state, we see a rapid pattern forming with the channel, a rapid decline followed by a downward channel. I often say that this pattern tends to test the channel's starting point. But what if it doesn't test it? Then it will accelerate after breaking down, leading to a climax movement. Here we come to a phrase I often mention. Rapid price movements can easily lead to exhaustion of momentum. Our main topic in this chapter is pullback patterns, which means trend trading. When looking at this chart, we want to find an opportunity to short on a pullback. Some people might want to find a simple pullback trading opportunity when they see this rapid movement. But if we carefully recall, what are the trading conditions for a simple pullback? Let me delete these lines first. They look a bit messy. We said that we only look for simple pullback entry patterns in the strong breakout at the beginning of the trend. So, what is the current market movement state? Rapid channel followed by a rapid movement. This is a clear sign of momentum exhaustion. So, we only trade complex pullback patterns after a deep pullback, not a simple one. So where is our first potential opportunity to go short? It's at the low point of the segment that was broken through earlier. We expect it to break through and then retest, forming a support-resistance swap. I don't enter before the price hits this level line. No matter how the price fluctuates, I can just watch and wait. Then someone might ask, what if the price doesn't retest to this point and just falls directly? Then let it fall, right? I'm not losing money. I only participate in trading at the most conservative position, time, and pattern. This is my trading style. Now, let's play the candlestick chart to see how the price retests this level. We see that it took quite some time for the price to return to this level, which is in line with our expectations, because we knew well in advance that it would make a complex pullback. In the beginning, we said that entering a trade takes 3 steps. First, we look at the larger market context, which is leaning toward shorting. Secondly, we look for an entry structure or pattern, and here, the pullback pattern is an upward channel. Finally, we look for a candlestick pattern for entry. Let's look at the subsequent candlestick trends. When the price retraced to this level, there were many overlapping non-trend candlesticks following it, which we really do not like to see. This type of overlapping non-trend candlesticks is an extreme trading range and very directionless. Continuing to observe, we see a candlestick with a long upper shadow, which made a false breakout against this level. This is a verification of the resistance level. Looking at the next 2 candlesticks, these are a double candlestick reversal. We have discussed this in our initial courses. In the larger cycle, it is a single candlestick reversal. These 2 price verifications indicate that the resistance at this level is effective, which gives us a good reason to enter a short position. After entering, the price didn't fall far before it continued to break upwards. At this point, our entry logic was denied by the market, and we had to reanalyze. After this level was invalidated, the high point of the previous wave is still far away. We can't consider the market to have entered a bullish trend yet. We still need to continue looking for reasons to short. But now we can see that the market has formed a clear upward channel, which is a bear flag, and it tends to break down. If you enter from the left, for example, if you directly short here, it is not impossible. But you have to place your stop loss at the logical stop loss level here, because only after the price breaks the high point of the previous wave can this shorting pattern possibly change. This upward channel line can be falsely broken. If your stop loss is very tight, it's easy to get stopped out. We wait for another entry candlestick pattern. Here, we need to analyze the details of the candlesticks. First, this big bullish candlestick only slightly broke through the previous level and is still within the channel. It's not a trend breakout. We must understand that it's not a trend breakout. Looking at the second long bullish candlestick, it also slightly broke through the previous level. Pay attention to the phrase I use, slightly broke through. In other words, do not identify it as a strong bullish performance. It's not a trend breakout. It's just a rapid movement within the range. Many novice traders cannot correctly understand these big bullish candlesticks. Seeing these, they think they are strong trend candlesticks. In reality, they are not. Such rapid movement has not broken this channel line. It's just a rapid movement within the range. Here's another point to mention. Upward channels, downward channels. They're actually inclined trading ranges. Let's look at this candlestick. This is the entry candlestick we've been waiting for. First of all, the 2 previous minor breakouts showed that the bullish momentum was insufficient. After the bullish momentum was insufficient, there was a brief period of sideways movement. These are all overlapping sideways non-trend candlesticks. You can interpret it as a pullback after the breakout or as a failed breakout. Neither interpretation is critical. But when this candlestick marked with an arrow comes out, we need to analyze the balance of bullish and bearish forces in the market. After the bulls have accumulated strength through adjustments, they should have broken upwards to start a new trend. However, the appearance of a false upward breakout indicates that there is no follow-up bullish strength here. At this point, the bears hold the advantage in the market. This is our reason to short. At this point, when entering the market to short, place your stop loss above the previous high. As long as the previous high is not broken, the overall shorting market pattern is healthy. Now let's continue to observe the subsequent price trend. What happens next is actually quite simple. The price plummeted swiftly. Finally, let's briefly summarize how this short trade was executed and how we participated in this pullback pattern. The broader market context is bearish, so we only wait for a deeper position to short. The first short position we anticipated was at this stage high's horizontal line. We were hoping for an upward pullback to form a support and resistance flip. However, after entering, we were invalidated by the market, leading to a stop loss on this trade. After the first short entry was invalidated by the market, we continued to wait. We were then presented with a new short opportunity, which we participated in and made a simple profit. Even though you incurred a stop loss previously, we can see that the profit from this trade is not concerned with that stop loss. Overall, you are profitable. This is the logic behind our short trade this time. That's for today's video. And if you like this content, please like, comment, and subscribe so you won't miss out. And I'll see you in the next video.